Hey, and welcome to the Loans 101 presentation. My name is Carl Tart, and I am a graduate assistant for the Student Financial Management Center here in the Living Career Center. So let's go ahead and get started. So these are your different types of loans. Loans can come in any size, any value, and can occur any type of interest to pay back. So a mortgage is a type of loan that you use when you're buying a house, uh, a condo, or any other type of home, any other type of living space. So you'll obtain a mortgage loan when you're trying to find your place to live. You'll obtain an auto loan, of course, when you're buying a car, whether it's new or used. Student loans are to pay for your higher education. These can be private loans or the federal loans that you get through filling out your FAFSA information. You have small business loans, where used to start or grow a smaller business into a bigger business. We have personal loans that you use for any purpose as long as you pay them back. And you have payday loans, which is money that you borrow between your paychecks. But you have to be careful with these because they have very high interest rates. So make sure that you are paying attention to what type of loan that you're pulling out so that you're able to repay all of the money back as soon as possible. So these are the different aspects of a loan. And so one key thing that you should know is that the principal is the amount that you borrow. So like let's say for instance you want to take out a $2,500 student loan, the principal amount is at $2,500. Anything that is added on to it is interest. And so interest is actually just the cost of borrowing money, and your interest is based on your credit score. So this is the amount that you have to pay in addition to the principal. So when you take the principal and you take the interest and you put it together, that gives you the total value of your loan that you're taking out. Uh, your annual percentage rate (APR), you might hear APR a lot when you're buying cars, is the sum of the interest rate plus any fees. Um, and so make sure that you're paying attention to the APR. The lower the APR, the greater the chance that you will be able to afford the loan that you're taking out, repayment of the loan that you're taking out. Um, Payments are usually called installments, but you can also call them payments as well. This is how you pay back the loan over a scheduled period of time. So it's a predetermined amount. It's usually take the principal and the interest and any fees calculated together, and you divide it over a certain period of time, and that's how much you pay a month. And all right, and the term is the time that you have to pay back the loan. And so terms can go from 12 months, 24 months, 36 months, and they also can go in years, 1 year, 2 year, 3 year. It all depends on what you and the loan provider figure out. All right, these are also the different types of student loans. So you have federal student loans, which can come in three different versions. You have the direct subsidized loan, the unsubsidized loan, and the plus loans. So the difference between the subsidized and the unsubsidized is that with the subsidized, you do not get charged interest while you're in school. So that's kind of a positive of taking out a student loan, a subsidized student loan, is that you only keep remain the principal amount until you finish school, and that's when interest starts to curate on the loan. Unfortunately, with the unsubsidized loan, you pay interest at all times, and so even if you're in school, um, the loan accrues interest over time. And with plus loans are available to graduate students or parents of undergraduates who have either reached the loan amount or cannot borrow in their own name. And so plus loans are a great help to students who want to continue their education um, but do not have the necessary financial aid or financial means to do so. You also have private student loans, which are offered through banks and credit unions. They often have higher interest rates than federal loans. They often require a cosigner. So a cosigner is anyone over the age of 21 with good credit who will vouch for you saying that you are able to repay the loan and that you are a good person. Um, and so these private student loans are not qualified for forgiveness programs, such as the Public Service Loan Forgiveness Program. And so the good thing about federal student loans is that they do qualify for forgiveness programs. So, like if you work for healthcare or you work in public service or any type of company or organization, like for instance, the state of Louisiana, you do qualify for certain loan forgiveness programs that will basically just cancel out your debt for you. So make sure you're looking at those type of programs when you're seeking employment. All right, this is how you see your student loan summary. The Federal Student Aid Office allows you to track all student loan borrowers, student loan debt. And so all you do is go to studentaid.gov and you log in. You click view details to see a full breakdown of your loans, and you use this information to stay informed of how much you are borrowing. You can access the servicers of your loans. You can see past and future payments, and you can see all of the interest that has been added to the loans since you've been in school. And so, in the picture right here, there is like an accurate representation of what that website looks like when you're looking at your student loan summary. And so now we're going to talk about a little bit about monthly payments. And so this is the basic calculation of a monthly payment. Let's say, for instance, you get a principal loan amount of $10,000. Your interest rate is 3%, and that's over the course of 10 years. That means that you will probably have a payment of about $96 every month to pay this loan back over 10 years. And so the variations right here at the bottom show you that if you were to decrease the loan amount, um, basically you're going to pay less. And then if you were to increase the loan amount, you're going to end up paying more. Um, and so it kind of shows you like how loans work, how interest rates work, and how repayment works. All right, so your total amount repayable. This is a tale of two $10,000 loans. And the biggest lesson that you can get from these graphs is that if you pay more monthly, you end up saving more money over time. And so let's look at the first block right here. So they have a monthly payment of $96.56. So but as you can see, they even though they had the lower payment amount, they also made 120 payments, and they were paying for an extra 5 years. And as you can see, they were charged more interest. They actually paid more money than a person who was at a 5% interest rate with a 5 year term. That person paid almost $300 less over time, just by making higher payments and over 60 payments rather than making lower payments over 120 payments. So what if you do pay ahead on your loans? If you kept your 10-year loan and 3% interest rate, but paid double monthly, a minimum, you'd save 5 years and 5 months. And you also save $872. So this is so greatly important to know that the more you pay over a shorter time, that you actually save money over the long run. And it might not seem like a lot while you're paying it, because of course, who likes to pay bills? But when you get to the end of the loan and you see how much money you've saved, trust me, you're gonna be really happy with yourself. And so taking out a loan, here's what you should consider. Think about whether you really need a loan or not. Is there another way that you can pay for it? Can you save up for it? Saving is the best option because loans can get quite expensive. What is the principal balance? What is the APR? What is the term? And what is the total amount repayable? So All of that information is important when deciding what type of loan that you're going to take out because it all factors into how much you're going to pay per month and how much does that payment fit into your budget when you're with your other debts and your other expenses. And also, it's very important to have a plan when you're taking out a loan. All right. If there are any questions, please feel free to contact me or someone in the office using the contact information on the next slide. Um, we are a part of the Olin Career Center. We are located on the LSU Student Union first floor. All of the resources that I discussed in this presentation can be found on our website at lsu.edu/sfmc. And you also can email us using the sfmc at lsu.edu or me personally indirectly at careercenterga6 at lsu.edu. Thanks so much.